March 3rd, 2026. The Dow Jones drops 1,075 points in a single session. And if you know your history, you know exactly what that means. Because since 1929, every single time the Dow has dropped 1,000 points or more in a single day, a major war has followed. Not once, not twice, every single time. That morning, the United States announced major combat operations against Iran, and the market had already seen it coming. Now here is the question nobody on financial television is asking. Was the market reacting to war, or was it predicting it? Because if you go back through the last century, through every major military escalation this country has been involved in, you find the same fingerprint. A single session drop at or above 1,000 points. Every time, without exception. 4 times the threshold was crossed. And what followed was not a market correction. It was not a buying opportunity. What followed was war. And right now, in March of 2026, that same signal just fired again. So today we are going to break down exactly what this pattern is, why it has worked every single time since 1929, and what it tells us about where the world is heading right now. Most people think the 1929 crash was just a financial story, a bubble that burst, rich men going bankrupt overnight. But it was never just about money. The crash of 1929 was the starting gun for the deadliest conflict in human history. Here is what happened. In the 12 months after the crash, the United States passed the Smoot-Hawley Tariff Act of 1930. On paper, it was designed to protect American industry. But what it actually did was trigger a global trade war. Every major economy fired back with their own tariffs. And within 2 years, international trade had collapsed by 65%. Now, if countries are trading with each other, war is expensive. War means losing a customer. War means losing a supplier. The economic ties between nations are what make conflict irrational. But if you remove those ties, you remove the cost. And if war stops being expensive, it starts becoming an option. That is exactly what happened. The crash did not predict World War II. It created the conditions for it by destroying the one thing that made another world war unthinkable. Now, here is why that should concern you today. Because in 2025 and 2026, we are watching the same sequence play out. Tariff escalation against China, trade barriers against the EU. The same unwinding of economic interdependence that kept the major powers from fighting for 30 years. The 1929 playbook, running again, in real time. The 1929 precedent is the blueprint, but it is not the only data point, because this pattern does not happen once. It keeps happening. October 19th, 1987. Black Monday. The Dow drops 22% in a single session. That is still the largest single-day percentage drop in the entire history of the market. And within 12 months, U.S. forces were in direct combat in the Persian Gulf. Operation Earnest Will, the largest naval convoy operation since World War II, was underway. The Iran-Contra crisis peaked. The Cold War entered its terminal phase. Now, if you are thinking the crash caused all of that, that is not the argument. But here is what is. The market saw what was coming before the public did. Institutional investors, the sovereign wealth funds, the pension managers, the hedge funds, with intelligence-level geopolitical relationships, they were quietly exiting their positions months before a single shot was fired. So if the crash did not cause the conflict, what was it? It was a read. The smartest and most informed money in the world looked at the geopolitical landscape in 1987 and decided it was time to get out. And they were right. The volatility was not a reaction to what happened. It was a preview of what was coming. Most people remember 2008 as the year the banks collapsed. The housing market crashed, Lehman Brothers went under, but what happened after that is the part nobody talks about. 2 years after the crash, the Arab Spring explodes across the Middle East. Tunisia, Egypt, Libya, Syria, one after another, governments that had kept a lid on their populations through economic stability suddenly could not deliver that stability anymore. NATO enters Libya. Syria descends into a civil war so catastrophic it pulls in Russia, Iran, Turkey, and the United States all at the same time. The 30-year window of relative peace between major powers, the era where economic growth had made large-scale conflict genuinely irrational, that window closes. And here is the mechanism. It is the same every single time. When governments can deliver prosperity, their populations tolerate them. But when the economy collapses and they can no longer do that, they need a different reason for people to rally behind them. So they reach for the oldest tool in the book, an enemy, a cause, a conflict. Economic collapse does not just hurt people financially. It removes the one thing that makes war too costly to consider: And the moment that cost disappears, history shows us exactly what comes next. March 2020. Markets drop 34% in 33 days, the fastest bear market ever recorded in history. And within 24 months, the world looks like this. Russia invades Ukraine, the largest land war Europe has seen since 1945. Iran pushes its nuclear program to near weapons-grade enrichment. The Gaza escalation begins. 4 separate conflict zones ignite across the globe, all within a 2-year window of a single market event. But 1 time is a coincidence, 2 times is a pattern, 4 times, with the same sequence playing out the same way across 100 years of history, that is not a coincidence anymore. That is a structure, a repeating mechanism built into the way economies and governments and conflicts interact with each other. And once you understand that structure, you cannot look at a market crash the same way again. So why does the 1,000-point threshold matter? Because the number is not what matters. What matters is who is selling. Retail investors panic all the time. A drop of this size and speed does not come from retail. It comes from sovereign wealth funds, pension managers, hedge funds with geopolitical intelligence relationships most governments would envy. Smart money does not panic. When it moves at this scale, it already knows something the public does not. On March 3rd, the market dropped before the combat operations were even announced. The institutions moved first. And when that much money exits simultaneously, governments get cornered, credit tightens, borrowing becomes expensive, and leaders under pressure reach for the one decision that never needs an economic justification because it comes with its own, military mobilization. And history has shown us every single time what that leads to. Return to March 3rd, 2026. The major combat operations announcement was not the cause of the drop. The market had already priced in the instability before the announcement was made. The announcement was simply the confirmation. 3 signals fired simultaneously that day. Oil spiked, Treasury yields inverted, and the Dow crossed the 1,000-point threshold in a single session. Those 3 signals occurring together have preceded every major US military escalation since the Gulf War. But there is something about 2026 that did not exist in any prior instance of this pattern. China is not a bystander. For the first time in the history of this signal, a near-peer economic and military competitor is directly entangled in the conflict zone. Iran's oil runs through the Strait of Hormuz, the choke point through which roughly 20% of the world's entire petroleum supply passes every single day. China is Iran's largest oil customer, and China is now actively building a parallel financial system called CIPS, designed specifically to route transactions outside of the SWIFT architecture that the United States has used to enforce sanctions for 30 years. This is not a regional conflict. It cannot be contained the way the Gulf War was contained. Every prior instance of this pattern involved the United States operating against an isolated adversary with no major power backing them economically or financially. That is no longer the case. The market already understands this. The question is whether the people watching the market do. If you have made it this far, you already understand something. Most people scrolling past this video do not. The pattern is real. The signal has fired, and the sequence that follows has never once played out differently in the last 100 years. If that is something you want to understand, subscribe, because that is exactly what we are covering next.